By the end of this video, you will know why value investing in its purest form is kind of overrated, why it's not a winning strategy going forward, and what you can do about it as an investor. What's up, world? Michael EJ here, helping you reach your financial goals and dreams by becoming the best investor that you can be. If you're new to the channel, welcome, how's it going? Helping you with different stock market tips and tricks to think differently than the market. Because I truly believe you can't beat the market by thinking like the market. You gotta think differently. So if you want some different ideas of how to do well in the stock market, make sure to subscribe, like this video, and let's get started. Now, I already know I'm going to get a lot of hate for this video. I already see it coming because I am going against the grain, against a lot of people who are truly connected to value investing. Now, I'm going to give you the definition of how I see value investing. Not valuation per se, because valuation is always important, but value investing in its purest form. Now, to me, when I think about that, there's really two criteria. Either you're trading at a multiple below the market, mainly a PE multiple. You're trading at a PE multiple, maybe price to sales too, I'll say that as well. You're trading at that multiple below the market, or your price to book is below 1. That is my true criteria as to what's really what you would consider a value stock. Now let's take a step back. Why would a stock trade below the market? I mean, that's kind of a low baseline. I mean, trading below the S&P 500. There is two main reasons why a stock usually trades below the market. One is high risk. It is a risky stock. Bankruptcy, lots of debt maybe. Just do you know if the company is going to survive? It's in a down industry, an industry that people just think just not going to work out. It's in a cyclical industry, so it has its ups and downs over time. Just a lot of different reasons why stock usually trades below the market. Also, another reason is little to no growth, no growth prospects. I mean, we're trying to see the stock market rise. Usually stock market rises as profits rise. So if you're not going to grow, if your earnings aren't going to grow, why should I invest? I mean, you get some good dividend stocks in there. If you're a dividend investor, that's fine. But pure value, I mean, hey, there's no growth happening. Or at least the market doesn't see the growth. You may see it, the market doesn't see it. Or it might be risky growth. So they're connected. I'll say that the high risk is more of the contrarian guys. They are the ones that look at beaten down companies, might even look at small and micro cap companies in value. And I'll say that the no growth prospects, they tend to be larger cap companies that just don't have that much more room to run. I'll call that quality value. So high risk, that's more of the Ben Graham cigar butt investing. Quality value is more of the Buffett types. Now, when does value investing really work? What is the market environment that value investing really thrives in? It thrives the most in a true risk-on market environment. What's the best true risk-on market environment and the most consistent risk-on market environment? Economic recoveries. Right after the market crashes and falls apart, the initial bounce back. And the stronger the bounce back, the stronger value investing performs. But there's more details behind it. See, the bounce back is really caused by the high risk assets because they're the ones that fall the strongest during a market downturn. In a recession, they fall hard. So they set a very low baseline for them to recover off of. And if economic growth is really good, if the economy recovers pretty well, they're going to do very, very well. I mean, there's some contrarian guys that killed it in 2009. Absolutely killed it. And did pretty well right after the tech crash as well. Why? Because, I mean, they're in more higher risk assets. And once people start feeling comfortable investing again, hey, they jumped all in. But these are also the same stocks that do the absolute worst when the market crashes. So the bounce back has to be pretty strong for them to come back. Well, the second group of value guys, the ones with little growth, maybe more of the quality value, they don't fall that hard. They don't fall nearly as hard. And the reason they don't fall nearly as hard is the quality aspect. In market crashes, investors always try to go after the quality names. The names that you and I know very well, well-established companies. They're not going anywhere. They're maybe even more connected to international operations. So yeah, they're the ones that usually don't fall off that much. They recover really well too. They tend to recover pretty well too, but this is what really drives that bounce back. That is the number one way to kind of see a risk-on environment. Two examples that's happened recently. 2009, like I mentioned before, and 2013, when the Federal Reserve lowered all the interest rates essentially to zero. They pretty much zero interest rates for the Fed funds rate. I have a video coming up talking about how the Fed impacts the stock market, so watch out for that. But that was another example of a true risk-on environment. Look how well the market did, and if you're a kind of a small cap value investor, that's a good gauge. Think about how well you did during that time. I mean, you absolutely annihilated the market. You killed it. I mean, maybe in those 2 years, you probably were up 100, 120, 150%. I mean, it was great. So economic recovery, true risk on is the best market best market environment that you can hope for as a value investor. Now, what's changed? Why do I think value investing is not going to work so well going forward? Well, partly, it hasn't worked as well as you thought over maybe the last 30 or 40 years. A lot of those studies, Fama French, Ben Graham, they go all the way back to the 1920s. I mean, that's where they really start. That's when a lot of studies go back to. The market has changed dramatically since then, to the point where over the last 20 or 30 years, if you actually look at the numbers, value investing has barely maybe inched above growth investing, or more importantly, depending on what time frame you're looking at, growth investing has beat value. Now, how has that changed? So first off, economic cycles are just longer. We're just getting better as a country in the United States of managing our economic cycle. Now, I'm going to leave a link below to a website, the National Bureau of Economic Research. They show how long economic cycles have lasted over time. And since the 1950s, economic cycles have lasted at least 7 years. It used to last only 4 to 5. It used to be quick, like let's get the show on the road. They start lasting longer and longer. And I'll give you a good example. Just look at the past 3 economic cycles. Early 90s, all the way through 2000, 8 to 9 years. Maybe 2001, 2002 to the end of 2008, about 6 years. 2009-ish to today, about 9 years. Usually value investing works really well 1 to 2 years post a recession. So that first 1, 2, 3 years afterwards is when value does well. Towards the end, towards the later end of an economic cycle, growth investing does very well because those easy picks for value aren't there anymore. So people start searching for growth, and that's when growth really starts to take off. Now, with longer economic cycles, value just doesn't get as many opportunities. It's not like it doesn't work, because it does, just the opportunities won't be there as much. More importantly, though, is that, like I mentioned, we have much more control over our economy, but our market's more efficient. The United States market is much more efficient than any other market in the world. How does that happen? How did that happen? Well, once we got off the gold standard in 1970s, we had rapid inflation. Inflation went through the roof. You can buy a 10-year treasury bond from the government and get 20%. What's the point of investing? Matter of fact, if you go back in time, just all the way up to the 1980s, go all the way up to the 1980s, you consistently get 10-year treasuries for 5, 6, 7, 8%. Why invest in the stock market if you can get that kind of return? Especially with the real money out there are the institutional investors, the pension funds, the endowments, the insurance companies, managing billions of dollars, even at that time, managing billions of dollars. And they only have 7, 8% expected rate of return they need to meet. Why invest in the stock market? Well, you can get that from the bond market, guaranteed from the government. So it used to be as many retail investors, you and me, versus institutional investors out there that invested in the market. 1980s came, Paul Volcker took over the Federal Reserve, made some tight controls over monetary policy since he could, since we're off the gold standard. And I'll put the chart in the description. You can see a steady decline in bond rates, just a steady decline from 20% in the early 80s to where we are today at 2% for a 10-year treasury. So you still got to reach that 7 to 8% if you're in an endowment or a pension fund. So where are you going to go? Well, expected rate of return over the long term in the stock market is 10%. So more money started to flood into the stock market. More money came, more professional money managers, more sophisticated ways of investing. Next thing you know, you got all these different investors, institutional money as well as retail money. And when institutions start to take over, now any type of margin of safety is wiped out, completely wiped out. Because as soon as a little bit shows, an investor comes in and wipes it out. Our market is just way more efficient. And a lot of the more successful investors today look at companies as they are, companies, like real companies, like forget the valuation. How does this company run? How will this company grow in the future? It's just a different perspective of how to look at the market today. So as an investor, what are you supposed to do now? How are you supposed to invest knowing that value hasn't worked for the past 30 years? Value hasn't worked as more institutional investors come to the stock market. Value hasn't worked since more professional money managers have entered. Well, I believe that you can beat the market, or at least keep up with the market in any market environment. Doesn't matter what's going on, risk off, market's falling apart, market is in hoopla, maybe even in a bubble, doesn't matter. You can do pretty well and beat the market in almost any type of market environment if you know how to strategically invest. Like, where do you know where to put the money? Now, for me, like I mentioned before, quality is where you start, because quality is what protects you from the downside. It's not value. It's not the multiple. Multiple doesn't save you. It's the quality of the company that saves you. Because when things really get rocky, people are going to go into the quality names. So we got the recession part covered. Knowing that there's longer economic cycles, you got to consider growth. Growth is where it's at. I mean, when the economy recovers, all boats rise, everybody does well. But when the economic growth starts to slow down, only the true growth names with high quality growth. You know, they're still a quality company, but they're growing pretty well. Those are the names that are going to continue to do well. Those are the names that the market's going to kind of go after. Investors are going to seek, because growth is kind of, you know, it's few and far in between. And when growth stalls, the growth names take off. Usually happens towards the end of an economic cycle. Longer economic cycles, got to consider growth. So we got quality down for recessions. We got growth down for when an economic cycle extends a little bit longer. But what about that recovery? What about that bounce back that, you know, the high risk stocks do really well in? Lucky for you, small caps and mid caps are right there with value. They work pretty well in risk on environments too, except the difference is that it doesn't matter what time period you look at. Small caps always beat large caps. I mean, you can make a case for over the past 10 to 15 years that hasn't been the case. But I would still say it's much stronger. I believe much more in small caps and mid caps versus value versus growth. I'll have a video on that coming up as well, why you should always consider investing in small and mid caps. And like I mentioned before, small caps, they're part of this high risk bucket. So you can just have more quality growth names in smaller companies in the beginning of an economic recovery. And as the economic cycle goes longer and longer, even when it hits rock bottom, just increase your allocation to larger names. Look for the larger quality growth companies. And you'll do pretty well no matter what's going on in the market. Value investing to me is dying. It's not dead because of quality value, mainly because I believe in the quality of companies. And you should too. And hey, if we're coming out of recession and you're still a value guy, hey man, low hanging fruit with the high risk stocks, excuse me there. So it still works. I still believe it works. I'm not saying value investing doesn't work, but what I'm saying is consider when it works And how many opportunities will you have for it to work? And that's what I have for you all today. I really want to know y'all's opinion on what I just presented you. My thesis as to why value investing is dying. Why I'm not a value investor. Why I'm more of a quality growth investor that loves mid-caps for the most part. Now you understand why I'm against value investing. Please let me know what you guys think. Michael EJ here, helping you reach your financial goals and dreams by becoming the best investor you can be. Make sure to subscribe for more videos and more interesting ideas, and I'll see you at the next one. Peace.